you do have to pay attention to the losses. Losses are very, very important to understand. This chart originally came from First Trust. First Trust is always bullish. Just buy the markets. Markets go up over time. So they came out with this chart, and I've recreated this. What this shows you is this is the percentage gains of bull markets and the percentage losses during bear markets going back through history. The general thesis is that percentage losses, they're nothing. That's just little blips on the road to making a whole lot of money within the markets. So as long as you are fine with the little blips here and there, you're good. Just keep buying the market. This is why you should just buy and hold investments and never really kind of worry about it whatsoever, because these drawdowns are very, very small. So here's a quote: bear markets have asymmetry to them, at least in the short term. In the long term, bull markets versus bear markets are asymmetric. And yet the bull markets completely overwhelm the bear markets. It's not even close. According to that chart, that's exactly what it looks like. Here's the problem. If it is true that bear markets are simply blips, why is it that no legendary investor, be it Warren Buffett, Paul Tudor Jones, has a rule that just says buy and hold? Every one of them. Warren Buffett, rule number 1, don't lose money. Paul Tudor Jones, cut your losses short, let your winners run. Not one single legendary investor has a rule that says buy and hold. So why is that? Second question is if every legendary investor has a rule that says they're supposed to buy low and sell high, then what's the point of buying and holding? Do these percentage drawdowns really matter? And the answer is yes, they do. Because again, there's two things that happen during bear market declines. This chart goes back to 1900. If you were born and on day one invested in the portfolios and you're still alive today, yeah, none of those blips mattered. You've made money. For most people, time is an important factor. Here's the problem with that chart, is because percentages are an illusion. If an investor bought the index and generated a 700% return on their money, then why worry about a 50% decline, right? See, this is the thesis, is that a 50% decline would only take me from a 700% return to a 650% return. That's not how percentages work. A 50% correction subtracts 50% of the gain. A 50% correction takes me from 8,000 to 4,000, which wipes out a lot of my gain. In fact, it takes me from a 700% gain to a 300% gain. Percentages are deceiving. This next chart is going to clarify it for you. All I did was take the original chart in percentages and just convert it back to points. How many points got lost on the index instead of percentages? Historically, the losses wiped out most of the previous gain. I'm not losing percentages. I'm losing dollars. This is a very important concept. Those blips are a lot bigger than you realize they are. And here's the most important fact about this. This is the math of loss. I've got an average return of 10% for 3 years. Year 4, I just lose 10%. Two things happen here. It reduces my average return to 5. And then to get back to a 10% return in the next year, I need a 30% gain just to get back to my 10% average.
Catch me daily on The Real Investment Show. The link is in the description.